What's going on, everyone? It's me here. So if you've ever wondered how banks actually make money, then look no further. Today, we're diving into their whole business model to uncover exactly where all their profits come from. And I got TAs say this is one of those topics that really makes you question everything you thought you knew about finance. So make sure to watch this until the very end so you don't miss anything. And also, please smash the like button for the YouTube algorithm and subscribe if you haven't done that already. Thanks, guys. All right, so first it's important to mention that there are two types of banks, commercial and central. Commercial banks are the ones that most people interact with on a regular basis, like your everyday Chase or Bank of America. They take your deposits and help facilitate loans between borrowers and savers. Now, in contrast, central banks are run by the government and they oversee all the other banks within a country, ensure that everything runs smoothly and maintain the overall health of the economy. This includes things like adjusting interest rates, regulating financial institutions, and printing physical currency when needed. Now let us talk about commercial banks because these are the ones that most of us use on a daily basis, and they can be broken down into 5 different revenue sources. The first being net interest income. This is simply the profit that a bank generates from holding and managing other people's money. In this case, they borrow money from someone else and then lend it out at a higher interest rate. For example, let's say you deposit $100 into your bank account. They might then turn around and loan 90% of that to somebody else who wants to buy a new car while keeping 10 as a reserve. That 10 that they keep in reserve is what allows them to stay afloat and cover any unexpected issues that could arise while still lending out the majority of their deposits. Now, the borrower would have to pay an interest rate of, say, 3% per year on that $90 loan, which means the bank could earn 27 cents every year just from holding on to your $100 deposit. Obviously, though, that doesn't mean you get to keep all 27 cents. Instead, the bank keeps most of it as profit and pays you some of it back as an interest rate for holding your money with them. But either way, that's how they generate net interest income, and it's usually their largest source of revenue. The second way that banks make money is through non-interest income. This is pretty broad, and it includes a variety of services that go beyond just collecting interest. One of the more popular ones is called interchange fees. These are the fees that merchants pay to accept credit cards and debit cards, and they vary depending on the type of transaction. On average, merchants typically pay between 1 and 3% of the total transaction amount, which might not seem like much, but add up 100 million credit card transactions and suddenly you're talking about a lot of money. Besides that, banks also make money through things like currency exchange, trading, investing, providing financial advice, selling insurance, and even charging overdraft fees and late payment fees. Moving on to number 3, we have something called bank spreads. And this is the difference between the interest that they pay customers and the interest that they charge borrowers. So if the bank charges a 6 interest rate to borrowers, but only pays a 1 interest rate to customers, then that spread of 5 can then be kept as profit. Historically, this was much higher than it is today due to deregulation and competition. However, throughout the last few decades, it's become increasingly difficult to expand profit margins as customers demand better rates and investors demand higher returns. The fourth way that banks make money is by selling financial products. This could include anything from offering financial advice to selling investments like stocks or bonds. Oftentimes, the more money that you have, the more personalized attention you get from a relationship manager, who helps guide you through the best options for your particular situation. Of course, that comes at a cost, usually in the form of higher fees, which is why it's common to see minimum balance requirements, account maintenance fees, and investment minimums. After all, it costs more to serve a wealthy client who has complex needs compared to someone who just needs a basic checking or savings account. And finally, the fifth way that banks make money is through assets that sit on their books. What I mean by this is that if a bank owns buildings, equipment, intellectual property, or anything else that can be categorized as a tangible asset, then they can lease that asset out to a third party. And in doing so, they'll receive payments that help boost their bottom line. So then, when we put all of this together, here's a visual representation of how all of this works. A customer decides to open a new checking account and deposit $1,000. The bank then uses $900 of that to issue a loan to a borrower who wants to buy a car, and then the rest is held in reserve. Now the borrower repays $1050 back to the bank over a year, which includes the original $900 plus an additional $150 as an interest expense. Meanwhile, the bank pays the customer $100 back in interest for holding their money with them, and the remaining $900 continues to circulate throughout the economy. From the bank's perspective, this is great because they were able to generate $450 in profit while still issuing a loan to stimulate economic activity. But it also highlights the fact that the vast majority of our money is not held in cash or gold or even property, but rather in the form of numbers that appear on our screens. When you think about it, that should probably be a little bit concerning. However, as long as we trust the system, then everything should continue working as normal. We trust the bank to hold on to our money and to loan it out to someone who needs it, while we receive a small percentage back as a reward. But as soon as people lose faith and start withdrawing all of their money at the exact same time, that's when everything begins to fall apart. Like during the 2008 financial crisis, people began losing faith in banks and started withdrawing their money all at once. The bank then didn't have enough cash on hand to go around, and that's when they began shutting down. Anyway, now that you know how banks work, let's shift gears and talk about central banks because they operate very differently. Central banks are run by the government, and their role is to oversee the entire banking system to ensure that everything operates smoothly. To do this, they control the supply of money in the economy and set policies that all other banks must follow. For example, the Federal Reserve is the central bank of the United States, and although they aren't technically a bank in the traditional sense, they oversee all the other banks to make sure they're operating properly. They also regulate financial institutions, print physical currency, and control the amount of money that flows throughout the economy. And to accomplish this, they have 3 tools at their disposal: the discount rate, reserve requirements, and open market operations. The discount rate is simply the interest rate that banks pay when they borrow money directly from the central bank. By lowering or raising this rate, the central bank influences how much banks charge their customers. For example, if the central bank lowers the discount rate, banks will likely lower their own interest rates as well, thereby making it cheaper for customers to borrow money. Second, we have reserve requirements. These dictate the percentage of deposits that banks are required to hold in reserve. If the reserve requirement is 10%, then for every $100 that a bank takes in, they must keep $10 on hand and only loan out $90 of it. By increasing or decreasing this percentage, the central bank controls how much money banks have available to loan out, thereby influencing the amount of money in the economy. And finally, we have open market operations. This just means buying or selling government securities on the open market. When the central bank buys government securities from banks, they inject money into the economy and increase the bank's reserves. On the flip side, when they sell government securities, they remove money from the economy and decrease the bank's reserves. It should also be noted that central banks do not directly take deposits from customers or issue loans. Instead, they only deal with other banks. Meaning, everything that we just discussed happens indirectly through the banks that we interact with on a daily basis. Now, after all of this, if you still want to learn more about economics, you should definitely check out this video right over here. It's a summary of the entire economy in under 6 minutes, and it explains everything from inflation to unemployment to taxes. So with that said, you guys, thank you so much for watching. As always, feel free to add me on social media. Enjoy. Thank you so much, and until next time.